soldiers over there in Iraq. Everybody might be on like on life back, you know what I'm saying? Stop looking at what you ain't got, start thinking what you do got. It's gonna make you
Hey, what's up, guys, and welcome back to Quiet Street Studios. Today is episode number 8, and we are talking about IPOs. So before we get there, go over our quiet market indicator. So we have gone down pretty significantly since our last chat. I have us at about 1.75. Again, countering in things like market sentiment and world events and things that are going on that are pushing the market downward. So we are at a relatively low place. We have some considerable upside potential, but I don't think necessarily we're at the bottom yet. So we may have some continued turmoil ahead, depending on your risk tolerance in your time horizon. That may be a very good thing. But if you're older and you don't have your allocations set appropriately, that could be a really bad thing. So winning the IPO game, we'll talk a little bit about what is an IPO, how to map out a strategy for an IPO into your portfolio, playing probabilities, building out these different type of risk profile positions. Certainly they're of higher risk, and then also potentially trimming them. So what is an IPO? Essentially, it's the first time that a private company goes public, and these shares are now available to purchase by anyone, essentially. So what is it really all about? Essentially, you have all these founders of the company and early employees and private investors that essentially are setting up a large payday. So they're trying to offer these shares essentially at a marketed price to new investors, and a lot of times it ends up being for them potentially an exit strategy. So a lot of times we see early management stages or changes early on. So we'll talk a little bit about that. But essentially it allows, what it's quoted as is allowing public users to participate in these newly issued shares. So the idea behind it, again, is that it allows the company to raise capital from these public investors, and investment banks are hired, again, to market these newly issued stocks. And essentially they're trying to determine how much can they get from the market. So it doesn't sound very good off the bat. It sounds like more of it's a strategy for the founders and people like that to make a big payday. But it's not all bad news. A lot of IPOs that have arisen have made many individual investors very wealthy. But it just becomes a different story on how we allocate those positions and how we play our cards a little bit differently. So that's what we'll be talking about today. Another thing to note with IPOs is lockup period. So really investing in share prices are all about support and resistance levels. So essentially these newly issued shares, there's a very large amount, and in order to keep them stable, the company founders again and early employees and things like that sign these binding lockup agreements where they're disallowed from selling any shares for a certain period of time. So the SEC requires a minimum period of at least 90 days. A lot of companies are longer than that, but they can be anywhere from 3 to 24 months. So essentially what that means to shareholders is that it could have the potential to be a very rocky road for the first 12 to 24 months. So typically for an IPO, I would consider it to behave that way for at least 12 months, but a lot of times it's even extended to longer than that. So we kind of consider them to be that, and we understand how that kind of risk profile has the potential to behave based on that high degree of volatility for that time period. And it's really because once these lockup years expire, the people that are the largest shareholders are ready to sell, get out, and potentially go somewhere else and get their payday. And there's oftentimes not a healthy balance sheet to back up and support the share price or the valuation. So there's not enough demand there to keep that share price stabilized. So a lot of times we see IPOs within the first 12 months of trading drop at least 20, 30, 40, or even 90%. And a lot of that we're seeing today, especially during different market conditions. So during conditions that have a lot of turmoil, like right now, there's not a lot of investment or investors out there to support those high level valuations based on where the company is at this particular juncture in time. And that can change with better market conditions or better improvements to their balance sheet and things like that. But typically you want to allocate these types of positions like they're an IPO for the first minimum 12 months. So we talked a little bit about management changes. A lot of times you get startup companies with new leaders. They may have a really good idea, but they don't have a lot of information or experience in managing a company that grows to the potential or the size that it is or the potential that it has to be. And also in addition to that, you see them being dropped a large amount of money all at once that they're really not used to managing. So they end up kind of saying, I did what I came here to do, and it's time for someone else to take the throne. So you see a lot of volatility in terms of the management structure early on as well. We're getting new leaders on that may be better able to support the business model than early founders that just kind of were part of a startup that took off. And again, the financial results also usually within the first 12 months aren't great, and that's pretty typical of any company. For the first 2 or 5 years, it's filled with a lot of instability. So another thing to consider is the way that the pay is structured for these high-level founders is often not as relevant as it should be to actual financial results. It's more so tied to the share price. So if you're an early founder and you're seeing this kind of heavy volatility for the first couple of years, and you're seeing it's kind of like a black hole in the way that your pay is structured, it's not really appealing for you to stay on, on that team to kind of help to support your salary and things like that based on how erratic the share price is. So a lot of early founders, again, end up jumping the ship. So that can cause further uncertainty within these type of companies that go public. So talking a little bit about probabilities here, when we're looking at the different types of positions that we're allocating funds to, here I would say more is more. So the probability of these companies being profitable after the IPO has dropped significantly over the past couple decades. So in 2009, it was actually really high. About 81% of these companies ended up being profitable. Looking back to 2020, it's more like 20%. So it's dropped almost 60% in terms of that. So in order, to be profitable for us as investors, we need to be even more careful. So having just a couple names there that you're building in your IPO bucket isn't necessarily a great strategy. You want to have maybe 5 or 10 to try to kind of counterbalance that statistic that a lot of these are not succeeding, which will be eventually reflected in the share price. So with something more stable like a blue chip, it might be appropriate to hold maybe 2 or 3 or 5 companies, whereas with IPOs, you're going to want to expand that a little bit to maybe at least 5 or maybe even up to 10. The second thing you want to consider is you always want to be considering what are your allocations. So think about it as a blueprint. I kind of try to separate it into my retirement funds. So those types of funds might be of my total, maybe they're 50% of my total, and then my personal portfolio is the other 50%. So I want to make sure that I have stability when retirement time comes, I have a lot of ETFs and things like that that are really stable. I can kind of set and forget that side of my portfolio. And then the other side is my personal portfolio, but I want to be thinking of mapping that out as well. So I don't just want to blindly throw different things in there. I want to position it in a way that's going to set me up for success. So for my personal risk tolerance and my age, it might look something like this. I kind of just threw this together pretty quickly, but the idea is the more stable types of assets like blue chips, bonds, ETFs are going to hold a greater percentage of that portfolio to kind of reduce the volatility and allow you to introduce the more risky positions in a way that if those are not successful, the portfolio still moves forward. So it's all working together as a team. And if those smaller portions aren't successful, it's still going to succeed regardless. So it's really allowing you to introduce that risk to kind of have those home run types of positions present. And they happen more frequently than you might think. But talking today about IPOs, so in this particular instance, if you asked me on a scale of 1 to 10, what's the risk of an IPO in general, I would say it's somewhere between an 8 and 10, depending on the company at hand. And I talked about that in full in my book and a couple more of my videos on how I determine the full risk of an actual security, but that would be more general. So we're here allocating a smaller percent. So say this entire bucket of IPOs, 2.5% out of 100 goes to 0. That's not really going to make any measurable weight. But at the same time, these are the types of companies that have the potential for 1,000 or a couple thousand% gains over the mid or long term. So it's something that you definitely don't want to ignore, but you want to approach it a little bit differently. So that step one is allocated appropriately to do just that. Step two is to build that position appropriately. So say our personal portfolio of our 50% is $100,000. We're working towards that, and we're going to be a little riskier than the last slide and say our IPOs are going to be 5% of that position. And we're going to try to, for simplicity today, expand it over these 4 different securities. So we have Pinterest, Robinhood, DraftKings, and Uber. Out of our 5,000, we're thinking Uber's a little bit less risky, and the other 2 are kind of similar in risk in terms of how they might behave. So if we look at, say, one of these positions, say Pinterest, we don't want to take that $1,000 that we want to allocate to it right away all at once and just jumping into a cannonball. We want to consider potentially price targets because we know this type of position is very volatile. So how you set that potential bottom, again, is up for your interpretation. And I talked about how I do it again in my book, Quiet Mike Speaks. But again, it really is assigned a risk profile, and it's determined a potential bottom based on you, based on your risk tolerance. So for this particular one, I would set a potential bottom of 10. So that first buy, I would kind of just really dip my toes in because I know it's a really low probability that that's going to be the lowest price I'm going to see. So I'm being patient, and I'm kind of expanding in my mind that this is a position I probably want to build maybe over 6 or 12 months to get to my initial target. So this is kind of what that might look like. So I'm being really patient, just kind of dipping my toes in at $50 at a share price of 30. If it drops down to $25, which is probably definitely going to happen, I'm going to put $100 in. If it drops down to $20, again, probably that's definitely going to happen. 150, you get to a little bit more of a gray area as you get lower, where it may or may not reach that target. But if it does, $15, we're going to put $300 in, $10, $400. Now, if those targets aren't met, you can always transition to a dollar cost averaging strategy. So say we're 6 months in and we're going up and up and up, or we're not really making any movement, you can decide to say, I'll still put that $100 in, but I'm going to kind of allocate this over the next 6 months in an equal portion, and maybe do $150 or so every couple months until I reach that 12-month mark. And that's okay too. But this kind of having this type of setup will allow you to supercharge the coil if it does happen, and it actually will be a good thing. So it's not going to change our sentiment about the security. We just understand that this is how this type of security often tends to behave, especially more recently. So we want to take advantage of that in some way. But it doesn't mean we're going to abandon that position. If it doesn't happen, we're going to transition to a dollar cost averaging strategy to get to the target allocation. The second part of that would be to trim appropriately. So based on certain milestones with this type of risk profile, we may want to consider removing a portion of that position once we reach certain milestones. So say, that did pan out and we have an average share price of around $20 where we're in for that initial position, and then it starts heading the other way. Maybe when it reaches $40, we may want to remove some of that position and reallocate it either to a cash reserve bank and kind of save it for a rainy day or for turmoil, or we may want to potentially allocate it somewhere else. The part of that position, got to the milestone that we wanted it to, and we're trying to reserve some of that capital. So essentially what we're trying to do is, as it's going up the other way, we understand this type of profile, how it has a tendency to behave, and the party could be over pretty quickly. So we want to reserve some of that capital. Typically, I'll do that up to the principal amount committed, and that isn't always my strategy that I'm going to do that fully, but it's potentially a good guideline, because if you do that, you could really remove your entire risk exposure. So you're removing everything that you put in and you're leaving in potentially house money. But based on on how you really allocate and how you remove some of that, or if you remove any, it depends on you and your risk tolerance. But for me, it might look something like this. And then when I reserve a good proportion of my principal capital, I may, if I really like that position, which I do, I would let it ride further. And going from a position of $2,000 to maybe $1,000 for some safe haven, in the long term, that isn't really going to make a huge measurable wake. If it's going to be a home run stock, it's going to be a home run stock. If it's not, it's not. So if it is, great, and that the rest of that position is going to go upward. And if it's not, that's okay too. I've recovered my principal capital and I've removed my risk. So I hope you enjoyed talking a little bit about IPOs today. These aren't recommendations by any means, and these aren't an all-inclusive list of what I'm buying, but lately these have been a few that I've been committing some new capital to during turmoil. I talked about in another video how I kind of change and structure how I'm allocating capital to different types of risk profiles based on the market conditions. So check that out. And if you want to learn the full story all at once, check out my book, Wyatt Mike Speaks, The New Age Guide to Generational Wealth. It's available on barnesandnoble.com and amazon.com. And if this all seems, too kind of complicated for you, and you don't want to worry about how different positions behave and think about all these different things, you kind of just want to invest in things that you believe in, check out Richly. We started a company a few months ago where we're building some artificial intelligence and robotics into this back-end process where you can essentially commit capital and you can invest like a millionaire without having any prior experience. So if that's of interest of you, stay tuned to that. You can follow us on LinkedIn. And we have some really exciting things to come. We just finished up our prototype and we're tweaking that and working on some beta testing. So again, stay tuned and look forward to chatting with you guys again soon. Take care.